Okay, so I've got a really exciting episode today about Paul Tudor Jones. So he's someone I've come to respect a lot after reading, watching, and listening to probably about 50 hours of content of him sharing his wisdom and strategies. And the big thing that really stood out to me after studying him is just how durable of a trader this guy is. He has this weird combination of hyper competitiveness with a laid back enthusiasm for life. And I don't know if he would actually admit to this because he does come across as someone who's extremely humble. But what's really odd about his story, and you're going to find out a little later on, is that he doesn't seem to lose very often. And I think a big reason for that comes back to his upbringing with his mother and father, which we're about to get into. As I said, in preparing for this episode, I must have read, watched, and listened to at least 50 hours of content, but a lot of the insights I'm about to share have come from his short interview in the book Market Wizards by Jack Schwager. And so if you haven't read that book, I highly recommend it. There's a link in the description. Go ahead, check it out, grab a copy. You're going to love it. I also managed to dig up some rare footage of interviews with Jones from the 80s, which were extremely insightful as well. So before we dive in, just a quick reminder, this podcast is not financial advice. I'm sharing what I'm learning about trading legends like Paul Tudor Jones, but nothing here is a recommendation to buy, sell, or hold any asset. Trading involves risk, and past performance doesn't guarantee future results. Do your own research and consult a professional. Okay, let's get into the story. So before Paul Tudor Jones became the trader he is today, before the billion-dollar calls and the losers average losers mantra, he was a kid growing up in Memphis, Tennessee. He was a Southern kid, a kid who attended faith-based schools and grew up in a home that likely valued two things above else: faith and responsibility. His father, John Paul Jones, or Jack as they called him, he wasn't a Wall Street guy. He was a lawyer and the publisher of the Memphis Daily News, a family paper that had been part of the city's fabric for generations. Jack started in that newsroom as a teenager, typesetting stories, running errands, learning what made a paper matter to a community. It's likely that the rhythm of that newsroom, deadlines, accuracy, responsibility, became part of the background of Paul's childhood. The Jones family story wasn't about chasing fortune. It was about service. The newspaper wasn't some national outlet. It was local. It told people what they needed to know about their neighborhoods, their businesses, and their laws. The family didn't just report the news, they participated in the community as well. And in later interviews, Paul hinted that both his parents believed in helping others, that if you had the means or the time to do something good, then you should. Years later, he would say that the moral foundation of his life came from that home environment and from the school that reinforced it. He once said, "Everything good I have done in my life begins with the religious training I received growing up. Most of my religious training came from my time spent at Presbyterian day school." And that's a rare thing to hear from a billionaire trader. See, he could have credited luck or genius, but instead he credited his childhood faith. Faith wasn't abstract in the Jones household, it was practical. And that influence seemed to come mostly from his mother. He's credited her with a simple phrase that stuck with him: "If you can't do something good, don't do it." That's presumably how she lived. And that's the kind of rule that gets under your skin early. You grow up hearing that enough times, and you start to build a filter for decisions. Is this right? Is this useful? Is this good? When you fast forward to Paul in adulthood, the way he trades, the way he leads, you can still see that early wiring. And so I think there's a straight line between a child hearing his mother talk about doing good and a trader later warning himself, don't be a hero, don't have an ego, always question yourself. And that's the same principle, just written in market language. So we could assume that his mother gave him conscience and his father gave him process. And together they gave him a sense that how you do something matters as much as what you do. That combination, faith and fact, morality and analysis, became the two rails his early life ran on. Even when he left Memphis for the University of Virginia, you can feel these roots under everything he's done since, from his defensive style trading to his belief in personal responsibility, which you could say drove him towards philanthropy relatively early in life. I think when you listen to Tudor Jones talk about markets, he doesn't sound like a gambler. He sounds like a journalist, I believe, trying to get the story right. He sounds like a son raised by parents who believed that your reputation, your integrity, mattered more than your balance sheet. So you can imagine those family dinners, those paper deadlines, those sermons at Presbyterian day school, they all seem to lead to the same lesson. If you want to succeed, start by telling yourself the truth. And that's where his story really begins, in a house where faith met curiosity, where words mattered, and where a young boy quietly started training for the mental battles of Wall Street. Okay, so after those early years in Memphis, Paul continued through two schools that would form the backbone of his education. So he attended as I mentioned before, the Presbyterian Day School, a Christian institution in Memphis that it blended academics and religious instruction together. I took a look at the school's mission actually, and it's very much centered on developing both intellect and character. And I think it's reasonable to say that the atmosphere there probably emphasized faith, discipline, responsibility. And those values are very much aligned closely with his home life as well. And so that environment likely reinforced habits of preparation, structure, and self-control. So from there, he went on to Memphis University School, or MUS. It was a college preparatory academy known for academic rigor and an emphasis on leadership as well. So MUS, it actually has a reputation for setting very high standards. Students are expected to meet deadlines, think critically, and carry themselves with accountability as well. And there aren't public accounts describing Paul's specific activities or achievements there. So the fairest thing we can say is that he came through an environment that rewarded consistency and effort. And those experiences, that faith at PDS, structure at MUS, it likely complemented each other as well. I would say that one shaped conscience and the other shaped discipline. Together, they built the kind of foundation that would later show up in his trading life: respect for rules, calm under pressure, and a sense of duty to perform well. So in 1972, he left Memphis for the University of Virginia in Charlottesville. His father, Jack Jones, had also gone to UVA and he studied law. So there was legacy here for sure, and family roots stretching way back from Memphis to Charlottesville. Paul chose to major in economics. It was probably a natural fit for this guy. He later described those years simply by saying, "My father went to Virginia Law School, so he steered me to the University of Virginia. I went to Virginia from 1972 to 1976, majored in economics, and had a great time. I really loved UVA." And it's easy to imagine why as well, because Charlottesville in the 1970s had this mix of tradition and ambition, had these old brick buildings, demanding professors, and a quiet competitiveness that hung in the air. And we do know that Paul definitely loved being competitive. So if his early years growing up in Memphis had taught him morality, UVA was probably where he learned competition and leadership. And so what we know about him is that he didn't just attend classes, he actually also got very much involved. He joined the fraternity Sigma Alpha Epsilon, which was one of the most active on campus. So I had to look this up because as a non-American, I'm not too familiar with how fraternities and sororities work. So what I found was that SAE has about 215 active chapters in the US. And from what I can tell, the thing that makes them slightly different from others are two things. Firstly, they have a big focus on continuous development, which includes leadership development and personal growth activities instead of the traditional pledging process. And then secondly, they make a strong effort with philanthropy. And I'm wondering if this experience is a big part of the reason why he's such an avid philanthropist today. So if you take a look at how much he does, you could make the claim that his identity is much more closely aligned to philanthropy than it is to trading today. And that is something that I think about and wonder if there's something to the idea that maybe generosity plays a huge part in someone achieving success and maybe maintaining success in the business of trading. And it makes a lot of sense because piling up stacks of cash might be fun for a while, but eventually it might not be enough to drive you to continue moving forward. So if you listen to my previous episode on the legendary speculator Jesse Livermore, you'll learn that he made money and lost it all several times before eventually committing suicide. So Paul Tudor Jones, he referenced Livermore in the book Market Wizards by Jack Schwager. So what we know is he must have studied him at one point in time. And maybe, just maybe, there's a possibility that he learned from his mistakes and realized that if he was going to stay in the game for a long time, he had to find some type of meaning outside of trading, and being exposed to this in college must have had a big impact on him moving forward. Anyway, eventually he went on to become the president of his fraternity, and that matters a lot because it shows that he chose leadership over sitting in the background. And we can assume that two aspects of his personality were probably developed during this time. Firstly, his people skills. There would have likely been a lot of competing personalities in this fraternity, and his job as president would have been to understand and adapt to every single one of them. And that's not easy to do. And then secondly, emotional control. Taking on that much responsibility, it doesn't come easy and requires a very stable mindset. And maybe it just came natural to him. It's possible for sure. Or maybe it actually was developed during this time at college. The only way to find out would be to ask him one day, which God willing, that's going to happen. I hope it really does. So that's one side of the UVA story. The other side is his boxing career. and he became the welterweight boxing champion at the University of Virginia. And if you think about that for a second, it's kind of a curious combination, right? He's studying economics by day, which is rational, it's analytical by nature, and then at night he's putting on gloves and he's trading punches with real opponents. It's hyper-competitive nature. I don't know why, but those two things together caught my attention because you wouldn't normally think of economics majors eventually becoming championship boxers, right? But then I thought about it more and I realized that boxing is actually very similar to trading. You win not by brute force, but by discipline, timing, and patience. You study your opponent. You read their patterns. When he said things like, don't be a hero, don't have an ego, always question yourself, you can hear the boxer talking right there. He probably learned in the ring that arrogance gets punished very quickly. Just one moment of overconfidence and you're on the floor straight away. Also, in boxing films, how often do you hear the statements like, protect yourself or keep your gloves up? Well, we do know that Tudor Jones pays far more attention to being a defensive trader than an offensive trader. And could this have come from his years spent as a boxer? Maybe. We don't know. What I do know is that's the exact kind of mindset that separates traders like him from everyone else. Boxing also likely showed him that he could endure pain and still stay composed. And that's not something you read in a textbook at all. That's something you have to earn. It's likely those fights did more than build toughness. They built pattern recognition. They built instinct. They built self-control. These are the same kind of traits that would later make him one of the sharpest market readers on Wall Street. But college wasn't all about fighting. It was thinking as well. See, economics would have given him that framework that he needed to make sense of the chaos around him. And even back then, the subject probably appealed to him because it explained why things happened, why people make the decisions they make, why cycles keep repeating themselves, why confidence and fear move through systems like electricity. You can see how those lessons would stick out, right? Because what is trading really, if not applied economics in real time? It's human behavior on a chart. It's incentives meeting emotion. It's decision-making under pressure, the same way a boxer decides when to punch, when to block, when to wait. And so by the final years at UVA, Jones had likely built three kinds of confidence: intellectual, physical, and social. So he could think, fight, and lead. And I think that's a really rare combination if you think about it. You can almost see the blueprint of the trader he's about to become. Analytical like an economist, instinctive like a fighter, and composed like a leader. It's not an exaggeration to say that the foundation for his future success was probably already becoming visible. I don't think he would have known exactly where he was going to apply it yet, but he already had the how. So when you zoom out, this is the part of his life where you start to see the pattern form, that quiet confidence that follows him everywhere into the future. He's not known for being loud. If you listen to him in interviews, he's definitely not boastful as well. So in every interview I've seen him in, it feels like he carries himself with a sense of calm certainty. And I think that many of the ingredients from that were collected during his early years and college. So by that, I mean the faith from home, the structure from school, the leadership and the fight from UVA. All of it converges at this point. So by the time he graduates in 1976 with a degree in economics, he's very much ready for the next chapter. He's already wired to compete, to analyze, and to adapt. He's already built for the long game as well. And all that's missing is the spark that will turn this foundation into a calling. So in 1976, he graduates from the University of Virginia with a degree in economics. And I think like a lot of people finishing college, he probably didn't have his life fully mapped out yet. So you can kind of picture this 22-year-old Tudor Jones, degree in hand. He's coming from a good family and probably asking that same question we all ask at some point. All right, now what do I do? And as far as I'm aware, he didn't actually have any Wall Street connections, at least not initially. And he wasn't a part of the New York financial scene yet. But what I can definitely say he had after doing the research was drive, and a lot of it as well. So somewhere in that period, he must have come across a story that would change the course of his life. In the book Market Wizards, he tells Jack Schwager, "When I was in college, I read an article about Richard Dennis, and I thought he had the greatest job in the world." And so Richard Dennis was a commodities trader known for borrowing $1,600 in the 70s and reportedly turning into $350 million. He was known at that time as the Prince of the Pit. I couldn't find the actual article he referenced, but clearly it had a big impact on him, and he must have decided then and there that he wanted to be a trader. It's one of those moments that you can't plan for. You just stumble across something that grabs you by the collar and it won't let go. And that's exactly what happened to Tudor Jones. And I love that as well, because it's just a reminder that sometimes your direction in life doesn't start with a plan. It starts with curiosity. And I think this can happen at any time in life as well. There are plenty of stories like Dan Zenga, for example, who started trading at the age of 46. He was working in pool construction when he decided to learn technical analysis. He would then go on to turn $16,000 into $40 million over the period of 18 months during the dot-com bubble. And so for Jones, this was his moment. And after reading that article, Paul decides he wants in. He probably doesn't know how yet, but he knows he has to find a way. And this is where family ties come into play. See, his uncle, Billy Donovan, was already a big name in the cotton business. He was a successful trader in Memphis. And so Paul calls him to ask how he can get into the business. And Billy connects him with Eli Tullis. And this is a really important person in Jones's life. He's actually at the time one of the top cotton traders in New Orleans. And so, by the way, he actually goes on, he credits Eli Tullis a lot throughout his career. In Market Wizards, when Jack Swagger asked him if he learned a lot about trading from Eli, he said, absolutely. Working with Eli was a fabulous experience. He would trade position sizes of 3,000 contracts when the entire market open interest was only 30,000. He would trade more volume than any cotton trader off the floor. He was a true sight to behold. He also said about him that he was the toughest son of a bitch I ever knew. He taught me that trading is very competitive and you have to be able to handle getting your butt kicked. And that line right there, I think that's such an important line right there. It tells you everything about what's coming next because the market's about to do exactly that to him. So at this point, he's now in New Orleans. He's 22 years old and about to start learning from a man his uncle called the best trader I know. Again, that man, as I mentioned before, is Eli Tullis. He's one of the most respected cotton traders in the country at the time. By all accounts, Tullis was known for his intensity, his size, and his composure as well. And we're going to mention the composure in a second with a really cool story. He wasn't a mentor in the traditional sense. He was just a professional trader running a serious operation. And that's where Paul got his start. So in Market Wizards, he said that working with Eli was a fabulous experience. He described watching him trade position sizes that were enormous relative to the market's total open interest, as I mentioned before. Thousands of contracts when most traders were just working in hundreds. And that's the kind of exposure most young traders never actually get. It's fully hands-on, it's real, and it's happening fast. Paul later said he learned a few key lessons from watching Eli work. One of them was about humility. He said, the market is going to go where it's going to go. That sounds really simple, right? But I promise you it's not. See, that sentence, it tells you that he learned early on that control is an illusion, that no matter how good you are, the market decides the outcome. That perspective probably came from moments like the one he describes in Market Wizards, where Eli was losing a large amount of money, but showed complete calm. And I actually really love this story. So Paul said that Eli, he once hosted this meeting with some of his clients' wives while he was down heavily. And instead of panicking or acting anxious during that meeting, Eli sat there calmly, having a really polite conversation. And he had no visible stress. He wasn't angry. He was just fully composed. And that made a deep impression on Paul because think about what that teaches a young trader. You're watching someone lose big and still act with a sense of dignity and calm. It's like watching a masterclass in emotional control at a very young age. Remember, he's only 22 years old here. Paul would later say that trading is one of the most competitive things you can do and that you have to be able to handle getting hit. And I think this story about Eli shows where that belief came from. It's not about avoiding losses. It's about how you behave when they happen. And maybe that's why he admired Tullis so much, because what he was seeing every day wasn't just trading. It was temperament. Eli showed him what it looks like to take pressure and still stay level. He also showed him something else, which was the importance of thinking independently. Paul said that by watching Eli, he learned that markets can look strongest right before they turn, that even when everything looks bullish, that can sometimes be the best time to sell. And that right there, that's a contrarian insight. And it became part of how Paul thinks well into the future as well. I think you could actually say that, in fact, he's built his entire career around that idea that the crowd is usually wrong at the extremes. And I think that mindset traces way back to this apprenticeship, to watching Eli operate when most traders would have folded. It's also possible that this is where he learned patience as well. And there's no evidence Eli was a fast, impulsive trader. Everything you read about him suggests that he was deliberate, methodical, and confident in his read of the market. And Paul probably absorbed that too, because years later, when you hear him talk about managing risk and staying defensive, it's hard not to think of this period. He's seeing someone take large bets, but manage them with discipline and self-control. And as far as I can tell, that combination of aggression and restraint is one of the main things that separates professionals from gamblers. And that's what Eli represented. I'm sure looking back on that time, Paul would see this time as the real beginning of his trading education. He wasn't yet learning about portfolio theory or macroeconomics or anything like that. He was learning about behavior, his own behavior and everyone else's. What people do when they're winning, what they do when they're losing, and how the best traders stay the same in both situations. So by the time he left New Orleans, he definitely was not a master trader at this point, but he had something more valuable, I believe. He had a real understanding of what mastery looks like from basically just being around Eli 24/7. He's seen calm in chaos. He's seen strength without ego. And he's seen that survival comes before success. And so those lessons, they would stay with him for the rest of his career. So after his time in New Orleans with Eli Tullis, Jones decides to try something new. He moves to New York and he takes a job at E.F. Hutton, which at the time was one of the biggest brokerage firms on Wall Street. And by the way, he was really good at it. He later said in Market Wizards, "I was a broker for about 2.5 years and I was successful at it. But then on the flip side, being a broker seemed to rub him the wrong way. And he once said, I realized that what I was doing was immoral." And he went on to explain, "If a client lost money, it was not my money. If he made money, it was not my money." So there was no real emotional involvement and therefore no real accountability. I couldn't handle that. Now, here's what I think. I think this is the morality that he learned from his childhood. And that's what's talking right here. It sounds like he didn't like the idea of making money without sharing the risk and responsibility. And maybe that the idea of his incentives not aligning with his clients just didn't feel right to him. And I'm guessing, therefore, that he wanted skin in the game. He wanted to feel it, He wanted to know that if he was wrong, it would actually cost him. And for what I can tell, that's something he's carried with him for the rest of his life, which is that sense of accountability. Because if you look at his story from here moving forward, he never outsources risk. He actually does the opposite and he owns it. And I think that says a lot about who he is, about his character, about how he was raised. Remember, his father, he ran that local newspaper, right? Which is a family business that reported the truth to its community. So accountability was probably built into the family's DNA. And now you can see this moral thread is starting to run straight from Memphis now through to Wall Street. And so when Paul leaves E.F. Hutton, it's likely not because he couldn't do the job. It's probably just because he didn't believe in the way the system rewarded it. He later said, "I decided I wanted to trade my own money to be accountable for my own results." And I mean, this is a big decision to make because remember, he was very successful as a broker. And so he was giving up a sure thing by doing this. And now he's about to be accountable, not just for his own money, but also for others as well. And he mentioned that he actually allowed some of his friends and family to invest initially with him when he was first started trading. And this is around 1978, 1979. And at this time, inflation's still really high, commodities are volatile, and the US economy is going through some wild swings. But it's probably the perfect environment to learn in as well. And if you can handle that pressure, then you're definitely going to do very well. And so that's exactly what he does. He begins trading futures to begin with, cotton, currencies, commodities, the same instruments, the exact same instruments he watched Tullis trade, but now it's all on him. He has no clients to blame. He has no manager to fall back on. It's just his decisions, his own money, and his own results. And this is where I think his trading philosophy really starts to form, and possibly where he develops his defensive mindset as well. He later said in Market Wizards, "Don't focus on making money, focus on protecting what you have." And I think that sounds like something he probably internalized from Tullis, but now he's having to live it all himself as well. So every trade he now does has consequences. Every mistake he makes is going to sting a lot harder, but he's building calluses at this point. And it's not just those mental ones, but emotional ones as well. And I imagine these years right now, they were both extremely humbling, but also really exciting as well. And there are reports that during this period, he enjoyed the freedom that came with early success and the city life of New York as well. And so it was not just financial freedom. It wasn't just about that. It was also his emotional restlessness as well. And so he's free now, but freedom also means exposure. It means that every single tick matters. It means that discipline isn't optional anymore. It's survival. He once said, "Every day I assume every position I have is wrong." That's going to be a theme throughout the rest of this episode. And I think that right there is a very powerful line that needs to sink in for every single trader out there. It tells you that his approach to trading was through humility and not confidence. He also said in Market Wizards, "Don't ever feel that you are good. The second you do, you are dead." And so I imagine he likes to start every day expecting to be wrong, and he builds from that point moving forward. And so that kind of thinking probably came from this period. And so at this point, he's still relatively young, And he's already seeing what ego can do in the market. Actually, he told a story about a friend of his who made $10 billion in the stock market one year and lost most of it the following year. And so he has examples around him of what it looks like to lose everything. And my guess is that he wants to protect himself from experiencing just that. But at the same time, he's learning to live with uncertainty because you cannot avoid that in this game. It's not about being right, though. It's about managing risk when you're not. And this is probably a good time to mention one of his personal rules, which is he never allows himself to lose more than 10% of his equity in a single month. And here's what he said in Market Wizards about this. He said, "Don't focus on making money, focus on protecting what you have. Every day I make a mental stop loss. I don't allow myself to lose more than a certain amount of equity in a month, 10%. If I lose more than that, I stop trading." And so by 1980, he decides to formalize what he's doing. He launches Tudor Investment Corporation, a small firm that would eventually become one of the most successful hedge funds in the world. But in this moment, I can imagine he's just this young guy who wants to prove that he can survive by his own decisions at this point. And that's what I love about this part of the story. I don't think it's about the money yet. I think it's about integrity. He's not trying to build a fund to impress anyone. He's just trying to build a system that aligns with who he is as a person. He's likely just doing what feels right as well. And I think that's why this chapter matters so much, because every major decision he makes in life later, every big trade, every act of generosity, every piece of risk management advice, it all goes back to this, to accountability and to ownership, to having skin in the game. And I believe strongly that this period is where Paul Tudor Jones stops being influenced by others and starts becoming himself. So at this point, he's starting to make money. He's trading his own account. He's developing a rhythm and it's working. And actually in a bit, I'm going to share exactly how successful he was in the 80s because I promise you it's stuff of legends. But at this point, he's still young, maybe late 20s. He's already starting to get attention. And you can imagine the confidence at this point is starting to build. But in markets, confidence has a half-life, as we all know. Remember his quote from earlier? Don't ever feel that you are good. The second you do, you are dead. Because right around this time, after those first early wins, he experiences his first serious loss. It happens in cotton, which is the same market he first learned under with Eli Tullis. And at this point, he was still technically a broker. He was managing a handful of speculative client accounts, but he was also trading them like they were his own as well. Functionally, he was already a trader. So in Market Wizards, he describes it as the worst trade of his life. He said, "One learns the most from mistakes, not successes. I was a broker back then. We had a lot of speculative accounts and I was long about 400 contracts of July cotton. So he'd be buying it every single time the market dipped. He was convinced that it was going to hold, but then the market broke and it broke really hard as well. The market had been trading in a range between 82 and 86 cents and I was buying it every time it came down to the low end of that range. One day the market broke to new lows. It took out the stops and immediately rebounded about 30 or 40 points. Thinking that the selling pressure was done, he doubled down, even added another 200 contracts in what he called a macho trade. I told my floor broker to bid 82.90 for 100 July, which at the time was a very big order. Refco owned most of the certified stock at the time. In an instant, I realized they intended to deliver against the July contract. That's when he knew he was wrong. Instantly and completely. He said, I saw immediately that the market was going straight down to 78 cents and that it was my blood that was going to carry it there. And he said the trader next to him actually took one look at him and said, if you want to go to the bathroom, do it right here. Within a minute, the market was limit down. By the next morning, it was locked limit down again. And by the time it was over, his accounts had lost 60 to 70% of their equity. And he said, that cotton trade was almost the deal breaker for me. I was totally demoralized. I said, I am not cut out for this business. I don't think I can hack it much longer. But he didn't quit. And he said, that was when I first decided at that point, I had to learn discipline and money management. It was a cathartic experience in the sense that I went to the edge, questioned my very ability as a trader, and decided that I was not going to quit. And I think at this point, this is a very critical point, this is where the upgraded version of Paul Tudor Jones begins. He said, now I spend my day trying to make myself as happy and relaxed as I can be. If I have positions going against me, I get right out. If they're going for me, I keep them. He said that trade changed everything for him, his position sizing, his pace, and his mindset. He said he became quicker and more defensive. I'm always thinking about losing money as opposed to making money. And this is where his famous philosophy starts to take shape, which is my guiding philosophy, he says, is to be a defensive trader. Don't focus on making money, focus on protecting what you have. And that's exactly what he did. So from that point moving forward, he set hard limits on how much he could lose. So that rule that he set, that he mentioned back in 1989, was to never lose more than 10% of equity in a month. And if he hits that number, he stops trading. I couldn't find anything that confirms he still uses that rule today, but I would imagine that he does because he continues till today to reinforce the importance of being a defensive trader. So after the cotton debacle, Paul Tudor Jones, he recommits and he starts to rebuild himself from the ground up. He decides to become more measured and more businesslike. And I love what he said about himself. This is quoting from Market Wizards where he said, "Mr. Stupid, why risk everything on one trade? Why not make your life a pursuit of happiness rather than pain?" And I think right there, that's a very contrarian idea in the world of trading where you have to stare at a chart all day and experience massive amounts of pain all throughout your career. I don't know if you actually have to do that, according to Paul Tudor Jones. But what I can tell, after that loss in cotton, this idea became a cornerstone of his strategy as he went into his next venture, which was opening the Tudor Investment Corporation. So he launches it in 1980, as quietly as well, with his own money and a small pool from friends and family. His guiding principle from that point moving forward is simple: play great defense, not great offense. And so I can imagine that he's learned if you protect the downside, the upside takes care of itself. And I think that philosophy right there, it starts to compound, literally. So in Market Wizards, Jack Schwager notes, a $1,000 investment with Tudor Jones in 1980 would have been worth more than $17,000 by the end of 1988. That's a 17-fold return in less than a decade. But what's really fascinating is that he wasn't swinging for the fences just to get there. He was just applying structure and discipline. Plus, of course, a little help from the 1987 crash, which we're going to get to in a minute. But Schwager asked Jones about his change in trading style after the failed cotton trade, saying, "I guess you not only started trading smaller, but also quicker." And Jones replied, "Quicker and more defensive. I'm always thinking about losing money as opposed to making money. Back then, in that cotton trade, I had a vision of July going to 89 cents. And I thought about it, all the money I was going to make on 400 contracts. I didn't think about what I could lose." And I think this is where that process starts to define him in the lead up to 1987. He develops a style that traders still study today. It's a mix of short-term macro trading, technical awareness, and psychological discipline. Here, I think it's important to repeat that quote from earlier. Every day, I assume every position I have is wrong. And I think this is such a great line because you can imagine him walking into the office every morning, preparing himself by thinking that every trade could go against him that day. That is likely how he keeps bias out of the equation. It's also how he keeps fear out as well. And if you start each day expecting to be wrong, there's nothing left to fear, only to manage, okay? So the other thing that starts to happen during the 1980s is that his journalistic background starts to come out. So he starts zooming out and investigating larger trends. And that investigative instinct leads him to one of the most remarkable insights of his career. So in the 1987 documentary called Traders, Paul explains that he and his chief analyst, Peter Borish, started studying the 1929 market crash, not as history, but as a potential roadmap for what might happen next. So what they did was they overlaid the 1929 chart on top of the 1980s Dow Jones and found that the two markets were moving almost tick for tick. He said, "Peter and I overlaid the 1929 chart on top of the present market and they're identical." Then he went on to say, "It's amazing how history repeats itself. Human nature doesn't change." And in the documentary, you can tell that both he and Peter are quite committed to this idea, which leads them to believe that a market downturn is about to happen. And we now know that they were right. And we're going to get to that shortly. So by the mid-1980s, he's built not just a fund, but more so a framework for how to live inside the chaos of markets. And what we know is that he's managing risk across commodities, currencies, and equities. He's balancing technicals and instinct, short-term trades, and macro themes. When you look at photos or interviews from that era, you can see that he's really starting to form his trading identity. You can see the boxer and the competitor as he shouts orders at his brokers on the floor. But we can also see a remnants of Eli Tullis in him during interviews where he speaks really calmly with his southern drawl. And I think at this point, all the stars are about to align because what we know about the best traders in the world is that they don't make a name for themselves during the bull, but rather during the bear. And the market is about to break. Okay, so now it's 1987 and stocks have been climbing for years and almost straight up. Interest rates are falling, credit is loose, and optimism is absolutely everywhere. And so from 1982 to 1987, the Dow went from 777 points to over 2,500, which is about a 250% gain in 5 years. And a lot of it was actually driven by margin. And what triggered the beginning of the crash was a larger than expected trade deficit announced on October 14th, plus rumors of anti-takeover laws that threatened the merger boom at the time. Institutional investments were also using computer-driven model insurance. They were selling futures to hedge stock drops. This paired also with program trading at the time, which was essentially just automated stock sales to arbitrage futures, created a feedback loop. So what happened is that selling triggered more selling, which just amplified the decline. And roughly $60 to $100 billion in assets were under portfolio insurance, and program trading spiked to over 50% of New York Stock Exchange volume on crash day, which of course was October 19, being Black Monday, where the Dow plunged to 22.5%. Fortunately, Jones knows something is coming. In the documentary Trader from 1987, filmed just months before the crash, he and his analyst Peter Borish are shown sitting in their office comparing the 1980s Dow Jones chart to the 1929 market. They literally lay one over the other, week by week, peak by peak. And this is where Jones says in the documentary, Peter and I overlaid the 1929 chart on top of the present market, and they're identical. Borish nods at this point, and he points out that even the emotional tone of the two markets, the speculation, the leverage, the overconfidence, it's the exact same. And then Paul says something profound at this point. He says, there's no question it's going to break. I don't know when, but it's going to break. And it's important to note, he doesn't know exactly when it's going to happen. He only knows what will happen if the pattern holds, and it's going to be big. Then mid-October comes, and as you can imagine, the panic starts to creep into Wall Street when the Dow starts to fall. Some funds are actually wiped out entirely, but Jones and his team, they're calm at this point. So maybe not fully calm, but at least better prepared, because they started this process back in mid-1986. So by the time October 19th rolls around, they're ready. The Tudor investment team has been expecting a major break for more than a year, ever since they started comparing the 1929 and 1987 market structures. They'd built their strategy carefully. They were shorting index futures, which mainly the S&P 500, as the market moved higher and signs of exhaustion appeared. They weren't short individual stocks, just the index. So as the market opened that morning, selling pressure hit immediately. So it likely wasn't panic at first, maybe just a fast slide initially, but by midday, it was clear that something bigger was happening. Program trading had taken over at this point. Every time stocks dropped, computers automatically sold more futures to hedge, which drove the index down even faster. And from what we can tell, Jones and his team, they stayed focused. They didn't try to pick a bottom or fight the tape. They'd already built their positions, and now they were simply managing them. Throughout the day, they monitored the futures markets as they fell limit down multiple times. And this is where Jones shows his experience. Instead of trying to hold through the chaos, he starts to lock in profits, remembering what Eli Tullis had taught him many years ago. And by late in the day, Tudor covers most of his short positions. And that decision to close out at the end of the move ends up being one of the smartest trades of his career, because by the next morning, the market rebounds sharply. A lot of those paper gains would have actually disappeared. And then at this point, while the dust is still settling, they do something that almost no one else is thinking about in that moment. They go long bonds. See, Jones and Borish, they understood that the Fed would have to inject liquidity back into the system to restore confidence. And so they put on one of the largest long bond positions in the firm's history, expecting rates to fall as the Fed intervenes. And they're right again. Bond prices surge. That single two-part strategy, short stocks, long bonds, turns the worst day in modern market history into the best trade of their careers. And their numbers are absolutely staggering. The Tudor Futures Fund gains roughly 62% in October 1987 alone. And for the full year, the fund returns approximately 200% growth, or about 126% net after fees. And that's one of the highest returns ever recorded for a hedge fund in a year that devastated nearly everyone else. And to put it in perspective, most major funds lost money that year. Even with the rebound later in 1987, the S&P 500 finished up only about 5% for the year, meaning that while most of Wall Street clawed its way back to even, Tudor was up triple digits. And the key thing to remember here is that Jones didn't make that money because of one lucky bet. It was preparation. He was studying, he was testing, he was preparing for multiple outcomes to occur. He didn't know the exact timing of the crash, but he knew what the environment looked like when risk was completely misplaced. And I think this is where his journalistic curiosity and analytical discipline, they actually intersect at this point. He wasn't predicting, he was just observing. And that's something I think every trader can really learn from. He didn't try to be the hero who bought the bottom. He was the realist who planned for what others didn't want to see. And remember what he said, that he always assumes every position he has is wrong. And that mindset is what kept him in control when everyone else lost theirs. So while others are panicking, Tudor Investment was executing. While others were frozen, he was adjusting. And while others were hoping, he was just managing risk. And that's how Paul Tudor Jones turned the crash of 1987 into the defining moment of his career. And it's also where his reputation at this point is truly sealed. So now it's the 90s. The crash is behind him, and Jones is running one of the most respected hedge funds in the world at this stage. And I would imagine this is the part where he could have just easily coasted and gone on autopilot, but he doesn't. Instead, he keeps learning, he keeps refining, and he keeps asking questions. He once said, "The secret to being successful from a trading perspective is to have an indefatigable and unquenchable thirst for information and knowledge." And I think that quote captures exactly what made him different. I don't think he was ever driven by greed. I believe he was more driven by curiosity. And maybe this is the journalist expressing itself. I don't know. What we do know is that he starts expanding his macro lens at this point. He starts looking at currencies, interest rates, geopolitical shifts. He's no longer just trading price. He's studying cause and effect on a planetary scale and watching capital move like weather systems, seeing where pressure is building before anyone else feels it. And so by this point, I would imagine he's also starting to think a lot about longevity. I mentioned the legendary speculator Jesse Livermore earlier, who we know Jones definitely studied because he's referenced his name often in interviews. If you want to know more about Jesse and hear his story, it's actually in episode number 1. Now, Jesse's story is basically he made and lost everything multiple times throughout his career, and he likely had a very turbulent life because of it. And I think that Jones pays special attention to Livermore's story because he didn't want to end up the same. Remember his quote from earlier when he lost big on cotton. He said, "Why not make your life a pursuit of happiness rather than pain?" And I really think he took this to heart because as he enters the 90s, he starts to diversify a lot. And I've heard him mention this in interviews, saying that it's much easier to get big gains on a small fund than a larger one. And that's why in the 80s, when he's small, his funds saw an estimated average return of 80 to 100%, right? That's pretty crazy. 80 to 100% average annual return. While in the 90s, that dropped down to somewhere between 20 to 25%. That's something Livermore never did, was to diversify and manage his risk, as he went on to lose everything after his big win in the crash in 1929. Jones doesn't want to make the same mistake. Again, remember what he said, why not make your life a pursuit of happiness rather than pain? I think he also starts to become more selective about what risk means to him. See, back in the early days, risk was about losing money. Now risk is about losing focus, losing alignment, losing the reason you started in the first place. And this is where he starts talking publicly about purpose. He once said, and this is a slight paraphrase, by the way, "You cannot have significance in this life if it is all about you. You get your significance. You find your joy in life through service and sacrifice. It's pure and simple." And I think this moment is quite unique in the sense that most traders get addicted and actually stay addicted to the rush of winning and losing. And I believe the values instilled upon him during his early years are what enabled him to make this shift after winning big in the 80s. See, most traders who saw an 80 to 100% average annual return, they wouldn't want that to end. It's too addictive. It's too exciting. Actually, there's this great line in Market Wizards where he quotes Jesse Livermore saying that in the long run, you can't ever win trading markets. Jones then goes on to say, "That was a devastating quote for someone like me just getting into this business. The idea that you can't beat the markets is a frightening prospect. That is why my guiding philosophy is playing great defense." And now here's the thing. I still believe he's the same competitor, but now he's more so competing against time. He's trying to stay sharp, relevant, and useful in a game that never stops changing. And in that sense, the 90s and the 2000s become a bit of a masterclass in sustainability. By averaging a roughly 25% annual return in the 90s, he proves that staying power isn't about being the smartest trader in the room. It's about having the emotional maturity to keep reinventing yourself. I mean, if you think about it, by now he's seen it all in the space of less than 20 years. He's seen booms, busts, bubbles, panics. He's seen brilliant people blow up from arrogance and fear. He's seen cycles destroy certainty, and through it all, he remains consistent. And I think this is a far greater accomplishment than his wins from the 80s, making the transition from volatility into sustainability. And all of this is because his defense first philosophy. He once told a room full of traders, There is no training, classroom or otherwise, that can prepare you for trading the last third of a move, whether it's the end of a bull market or the end of a bear market. And that's such an interesting observation right there, because it's not really about markets at all. It's just about emotion. And you can read every book, you can backtest every strategy, but when you're sitting there at the end of a big cycle, watching prices go parabolic, nothing can prepare you for how that feels. It's that humility, the awareness that even experience can't save you from human nature, that I believe keeps him grounded. And by this point in his life, I think he's starting to see trading less as a way to win and more as a way to understand himself. And this right here actually makes me think about a great line in the book, Trading in the Zone by Mark Douglas, which is a fantastic book, by the way. Link is again in the description as well. Here's what he says. He says, trading is an activity that offers the individual unlimited freedom of creative expression, a freedom of expression that has been denied by most of us for most of our lives. And I think that right there is exactly what Jones had figured out by this point. And all he wants to do now is sustain it for the rest of his life. Okay, so that about wraps up this episode of Paul Tudor Jones. All the links to the books and other resources will be in the description. I'll probably record another episode about him in the future, about his life beyond the 80s and 90s. And just from what I can tell, his life seems to be split into two parts. And I wanted to cover the upstart trader part first, where he made all of his money. If I ever do a second episode, it's going to be about the lessons he's learned over the past 25 years. So if you got something out of this episode, please share it with someone who really needs to hear it. Also, get in touch with me on X at Traders Show, and I'll be back soon with another story. Until then, keep studying, keep evolving, protect your money, and stay in the game.